What's going on, everybody? Today's video is going to be on risk management. I wanted my first educational video to be covering this topic because this is the most important part of trading, and a lot of people get this part wrong because they're trying to swing for the fences or make as much money as possible. But at the end of the day, trading is a long game, and what matters most is not about how much you're making, but how much you're not losing per trade. So the way I approach it is in two ways. The risk per trade should be a fixed dollar amount, meaning you need to find a dollar amount that you're comfortable with risking per trade. How do you find that? Well, if you're risking $1,000 on one trade and you're very nervous or sweating during that trade, you're probably over leveraged. It's probably not a good dollar amount to risk. So you need to play with that dollar amount and get it to a point where, hey, if I lose this trade, I will not be bothered by the loss on this trade. So that's where something you need to play with a little bit to kind of find that dollar amount that when you're in a trade, you're like, okay, if this wins, awesome. If it loses, cool. You're cool, calm, collected. Doesn't matter what happens. Now, the second portion is position sizing should be variable based on stop loss or proper invalidation points. What I mean by that is sometimes you might have a 20-point stop loss, sometimes you might have a 40-point stop loss. So what you need to do is your dollar amount needs to be the same, but you can just adjust your contract sizing to fit that stop loss placement. So that's why I trade the MNQ, because I'm able to pretty much quickly change my contract sizes on the fly, and I can get a little bit more creative with how I'm placing my stop losses and what I'm actually risking per trade, or how many contracts I'm taking on that trade. So for me, on my funded accounts and evals, what I'm risking is usually 10% of my drawdown. So for example, on Top Step, if I have a 50K account, I'm going to be risking about $200 per trade. And as the account grows, my risk per trade also grows. So if I get that account to $5,000 and that's my drawdown, then I can risk $500, so on and so forth. If I get it to 10,000, I can risk 1,000 per trade. I usually target a 1 to 2 risk to reward. So I make, for every $500 I risk, I can make $1,000. So that's the way I approach funded accounts and evals. In terms of live accounts, the approach that I would take is probably doing about 1 to 2, maybe 3% of the drawdown, depending on the actual trade itself. Now, going back to the position sizing should be variable. I actually want to show some charting examples on this. So if we go to a trade that I would take right here, for example, I'm monitoring this on the fly. So I give it usually about a few points of wiggle room. I like to market execute on my trades. So right here, if I were to enter on this trade, I'd have about a 21-point stop. So I have this risk management tool that I've created myself. Now, if we go to M&Q future, my risk amount would be $400, and I have a 21-point stop loss, right? So I'll click submit. That gives me about 9.5 contracts. So I'd probably round that down and just do 9 contracts, 9 MNQ contracts. And then I would target 2R of that. So somewhere right here. And that'll give me the 2R risk to reward that I look for in every single trade. Now, if we look at a different setup, this is where it becomes very variable in terms of your position sizing. So if we come here, we can see here that there's a potential setup in here. Okay. So my entry would be in this area right here, for example. So this would mean I have about a 16-point stop loss. So that means I can increase my position sizing on this trade because I'm still risking the same dollar amount. So on this one, I can do about 12 contracts, and I'm still losing the same amount, and I'm still making the same amount every single trade. What you don't want to do is, hey, this is a 16-point stop loss. I'm going to run 1 mini on this, and then I'm going to make 2R of that, because what's going to happen over time is your losses will eventually, because if you're doing a full size loss on the next trade, it's going to cut into that profit that you're making per trade. So that's why it's very important to have a fixed dollar amount. Like I said, it's not always going to be perfect and spot on, but if you can get it as close to the dollar amount that you're willing to risk per trade, then you'll be really good in the long run. So that's pretty much my approach to risk management. And if you guys have any questions, please let me know.